Hey, folks. So I got a great question. How do you think about real yields and tips? And I thought I'd give you my brief answer on that. There's an auction, a 5-year tips auction on sometime later this week, Wednesday or Thursday. And you may want to buy it, you may not. I just wanted to walk through my thoughts on what are now quite high real yields. So let's go do that by sharing my screen. Okay, so here are the yields on tips. And as you can see over on the far right, tips yields are higher than they've been in quite some time. So the question becomes, well, I guess the first question is, what the hell is a tip? And so I'm going to start there because that seems like a good place to start. So a tip, which began being issued with a 10-year and a 5-year tip in 1997, is a Treasury insurance protected security. Inflation protected security. Okay, that's what TIPS stands for. A lot of people also call them inflation-linked bonds or linkers if you're from the UK. And the UK, like many things, was innovative first on issuing inflation-linked bonds. And so anyway, so that became a trend, and Larry Summers, and with a lot of help from Ray Dalio, actually, who loves linkers, convinced the United States Treasury to start issuing inflation-linked bonds, and they began in, call it 97. So what is an inflation-linked bond? Well, an inflation-linked bond is designed to pay you a real yield. Now, what a real yield is the return on a nominal bond, a regular old Treasury bond, protected by paying you the realized inflation during the period of time you hold the bond. And so if that's the case, if you're protected from inflation in your nominal bond purchase, all of a sudden that means that you just have the yield if inflation didn't exist. Okay. And that's what they call a real yield. And really, the idea is that in order to, businesses and consumers and everybody else who's borrowing and lending should have a yield that, if they were protected from inflation, would be happy to either borrow or lend at. And I'll come back to what that yield should be driven by in a moment. But the basic answer is growth. And so the real yield should track the growth in the economy. And that's an attractive thing to borrow and lend at. It's an attractive thing to plan versus, because real growth is much more predictable than nominal growth, which includes this volatile inflation series. So that was the idea. So mechanically, let's talk about what that is. Currently, you can buy the 5-year real at, this is for month end because I only had monthly data for some of these things, call it 2.25%. Okay, so what is that 2.25%? That doesn't sound great. 2.25%, when you can get 4.5% or 5% for nominal bonds and 5.5% for cash, doesn't sound that great. So if you buy those bonds and you're only getting 2.5%, or 2.25%, you have to think, is there more? And so the mechanics of a tip is at the end of the 5 years that you've owned this thing, you are given extra compensation, like literal money, cash money, at the end, equal to the amount of realized inflation there was over those 5 years. And so that's a bonus that gets your yield to be much higher, presumably. So that's what a tip is. Buy it today, get the real yield as they pay it, and get topped off at the end for any inflation that occurred. And that's how those things work. So let's go to what drives real yields. The answer to that is, by and large, real yields are driven by real GDP. As you can see, real GDP, back when these things started, was running at around 5%. And over time, with some squiggles around the Enron and tech bubble and the great financial crisis and the COVID crisis, this thing sort of has been tilting down. Real GDP has been tilting down for the past, 25 years. And so have real yields. Until recently, both GDP, after this big back and forth, both GDP and real yields have begun to rise. And so you have to ask yourself, are we going back to this period of time? If that's the case, real yields aren't quite there yet. But is it also realistic to believe that we are going back to that period of time? And that speaks to secular issues around growth. So what is real growth? So think about that as being a bunch of guys that make stuff, that produce stuff, the population that produces stuff, and their skill at doing it, which is called productivity. And so you have a population. If you add another person to the population, they can make more stuff. And if you get better at making stuff, you can make more stuff. So GDP is the stuff, is counting up the stuff. Real GDP is counting up the stuff we produce. And so population matters to GDP. If the population is growing rapidly, you're going to get GDP growing rapidly. If the population is shrinking, if the population is growing less quickly, you're going to get falling GDP or growing less GDP. And so then there's productivity. In China, there's been rapid real GDP growth for a decade or two, and that's because of productivity. They took people who were scratching out a subsistence living on a dirt farm somewhere in the country and brought them to factories in the city, and all of a sudden they could make more stuff. And so that created productivity. The US has had pretty stable productivity for a long time, and it's possible AI is the next productivity driver for both deflation, because more stuff gets made, and GDP, because more stuff gets made. But that's a different topic. The secular trend has been on population. And so, not surprisingly, as the US population growth has shrunk, and there was a bit of a series of deaths and recovery during COVID, the secular trend of US population growth is falling rapidly, and US population growth is, in the below single-digit increase. Now, obviously, one of the other things about population is immigration, because the US GDP depends on US population. And if we let more people in, besides having births, if we let more people in, our GDP can rise. I'm not saying that's good or bad. I'm just saying that's a fact. And chances are global GDP rises because workers who come to the States from countries that are less advanced get a productivity boost as well, often. So that's an interesting issue around immigration. But the secular trend is our population is declining. The world's population, China with the one birth policy that they're trying to reverse now, takes a long time to change the path. China's population is falling rapidly. Europe's population is aging. Japan's population is aging and growing less fast. So there's this big pressure on real yields based on the secular population change. And I don't think that's going to change in the near term. And it comes back to, if population doesn't go up, is this real GDP increase going to be sustained? Now, it can be if debt is issued, and that's part of this fiscal dominance that people are talking about, which creates both inflation, but also real GDP growth. So that comes back to, are real yields cheap at these levels? Probably, given the secular trends. But then there's a question of supply and demand, and whether it has, we've gotten through this period of time in which the US Treasury is issuing a lot of duration to judge whether this is really a great deal. It is a pretty good deal, like versus history. It's a pretty good deal. And given the secular trends, it's a pretty good deal. But then you go back and say, well, is it going to get to be a better deal? And my premise is, yeah, probably there's going to be a better deal in the future. Does that mean you shouldn't buy the 5-year tip at auction? If you gun to my head, I'd rather not buy it and wait for the next one. But it's also not bad. And so that'll create, and as more and more people realize, that'll create we saw this rapid increase in real yields lately, just in this section here, and as we all saw last quarter. But that's going to plateau more than go parabolic into supply, because there'll be people like you and me that are looking at real yields now and say, they're probably going to go a little bit higher, but, they're getting to be really cheap. Okay, well, let's see how it's gone. So then the question is, if that's true, why don't we just buy nominal bonds and not worry about these crazy tips? Well, let's just see how it's gone. So here's a performance comparison of tips versus nominals, and it's sort of busy. So remember what I said. You have the yield on the tip. This is the tip yield when it was auctioned, 356. And you have the nominal yield, the green line, which at the time was around 6%. Now, 6% seems much better than this, but you also got paid, this is the next 5 years of inflation that's realized. So in this case, you started with 357, you got 232, and you ended up after 5 years having realized, this is the actual return on tips in this red line, in this case, about the same as you did if you bought nominal bonds. And for this whole period, the red, I look at it and say, it's inflation protected notes, tips have, basically outperformed on a realized basis for, until just about here. And of course, here is when you have the financial crisis and a significant deflationary environment. And so owning tips was not great when you had deflation. So at that point, nominal bonds for an extended period of time have outperformed. But man, if you bought tips in 2015, and you caught the massive inflation in 2021 or 2020, if you bought them in 2016 and you got that massive slug of inflation, of course, tips have done great relative to nominal bonds in the last 5 years. This is nominal, not so great. Tips got that slug of inflation. Anybody who bought a bond before 2020, 5 years prior to 2021, got this slug of 2021 inflation. That was, that created some increasing outperformance. Now you have to ask yourself, will that keep going? So let's just look at it in terms of outperformance. I just subtracted the red and the green line. And you see, most of the time, tips have done better than nominals. This is an oddity around a very bad tips price at one point when my old firm tried to dump their entire position. Anyway, and so you did really well if you bought tips then. But in this period of time in which you have a deflationary recession, slow growth period, tips underperform. And so, the question is, what's going to happen in the future? So let's look at the current break-evens. So this is the difference between the nominal bond at the time and the tip. And currently, it's, about 2.25. By the way, 2% is the target for inflation. So not surprisingly, these numbers stay around 2% because the Fed acts when the break-evens are high, it tightens. When the break-evens are low, it eases. And so, is this a good number to buy? Should you expect going forward nominal bonds to outperform real bond tips or tips to outperform real? It's hard to say. I don't actually have a strong view. And if you notice in my beta portfolio, I'm pretty equal in nominal and tips because I don't know, that seems about right to me. So are tips just this massive great deal that you have to buy because they're yielding 2.5% real? No, they're not. They're just okay. And it really will depend on lots of conditions. Should you own them in a beta portfolio? Yep. Should you own nominals in a beta portfolio? Yep. That's what beta is. You should own a diversified portfolio, some protection against inflation, some without inflation protection. And, that creates a diversification. You're not betting on inflation direction by shifting entirely into tips or entirely into nominal bonds. You have some of each. And again, I'm pretty bearish on bonds ahead of this QRA on Halloween. It could be bullish. And I'll tell you when, and in that case, we'll chase bonds and try to buy both nominal and tips. But that's the picture. So now that also speaks to one other thing, which is in a good portfolio, you have this inflation protection from tips. But it's also nice to have other types of inflation protection. In particular, if the government were to pursue aggressive fiscal or the Fed were to give up on its inflation mandate, real yields might or might not fall in such an environment. In fact, it's unlikely that if the inflation, if the Fed were to give up on its inflation mandate or the fiscal side decided to print a bunch of money and spend, it's pretty clear that real yields would actually rise. But what wouldn't fall, and thus tips would fall, what wouldn't fall is gold. That would be good for gold. So I like gold too. But I think it's also important to compare gold, which is at its very basic is a rock that people use for currency in the past. It carries no coupon, it pays no interest, and it actually costs some money to protect and store. So it's got a negative real yield. And if you compare a negative real yield to something that has a positive real yield, you'd say, I prefer the thing with the positive real yield, all else being equal. And so that's why gold trades based on the real yields of the currencies that people exchange for gold. And so you can see that this is gold inverted versus real yields, meaning as real yields rise, gold falls, goes down in price. Now you can see those, it doesn't always work that gold is, exactly correlated. But, in big periods of time, you do see the same shape of these two things. And also, we've had real yields rise a lot, and gold has actually done okay, which is a big divergence from history. And so I like to look at this in scatter plot world. And so here's that in the scatter plot. Most of the time, as real yields rise, gold falls. As real yields fall, gold rises. Here we are. This is a monthly chart, so it's, not all the points you might want to see, but this shows in this period of time, real yields have risen and gold has done nothing. And so the question is there a reason for that? And I don't see the Fed credibility problem as the reason why gold is basically outperforming what it would as a pure real yield currency. I think this is the fiscal thing, in which out of control fiscal spending has created more money in the system, which increases the price of gold relative to its, not only simply because the quantity of gold stays fixed and the quantity of money is rising quickly. That's not a real yield concept, though there's related issues there. Anyway, I think that's what's going on here. And we'll get a convergence back to where the linkage is between real yields and gold if and when the fiscal side gets some discipline. Now, I don't know when that'll be, but that's the risk of owning gold. It's a little rich from a value standpoint. You're getting 2.25%, 2.5%, 2.75% real yields. And this thing is sitting in your vault costing you 20 basis points to secure overnight a year and doesn't pay you anything. It's not that attractive unless the Fed gives up, which is a possibility, but seems unlikely at this stage. Or more likely, the fiscal doesn't get its house in order and you just have lots of money being printed out there and handed to the economy in the form of fiscal deficits. Anyway, I hope this was helpful. This sort of is the basics around real yields. They tend to go with population growth and productivity. They are at higher levels than they've been, but so is GDP, and so is the fiscal impulse. We've got a period of uncertainty regarding the QRA and the supply that looks like it will create supply of long duration treasuries, thus these things, for a year and a half to come, at least, till QT is over. And so, that sort of frames the whole thing. Anyway, hope it's helpful. Have a good one.